The Center for the Promotion of Private Enterprises, that's the CPPE, has urged the CBN to adopt a flexible exchange rate regime as a means to improve the ease of doing business in the country. Addressing journalists at this year's first quarter economic review of the CPPE, the Chief Executive Officer of the economic think tank group, Dr. Muda Yusuf, explains that the CBN's current rigid attitude towards foreign exchange regulation is harming investors, causing distortions, and also delaying the Nigerian economy's economic recovery prospects. Thus, a flexible exchange rate and also regime should be implemented to solve these bottlenecks. He, however, maintains that this development will imply that the investors and exporters window rate would be discontinued in favor of a market-determined exchange rate regime.
All these malpractices in the foreign exchange market, over invoices and all of that, is because the foreign exchange policy itself is creating a problem. Because it is when people want to round trip, that is when they do over invoice so that they can ship out more dollars and bring it back. But if you move away from a subsidized foreign exchange, if you have a market-driven rate, all these malpractices will disappear. That is why it is important to ensure that in all these economic management issues, there should be proper coordination so that we don't have these economic ministries and agencies operating in silos. They are creating a lot of problems for investors.
Now, Dr. Muda Yusuf, however, urges the government to also fix the structural problem in the economy to enhance the regional and global competitiveness of Nigeria's products to boost exports and strengthen import substitution.
Ultimately, you should have a situation where the private sector is in the driver's seat. The government can have shares. Just as people always make example of the NLNG. Government has shares of about 49%. Private sector has 51%, but the private sector is managing the place. That is why it's doing so well. So we can replicate that model in all the key functions of NNPC, apart from the regulatory aspects. I think we will have made significant progress.
And now the Nigerian luxury real estate market is getting a significant boost from increasing number of wealthy individuals who are seeking to own multiple homes and new portfolios. The luxury residential market increased last year as a result of the impact of the COVID-19 pandemic, as many in the working class saw the need for better homes with access to facilities that encourage work-from-home policies. According to reports, Port Harcourt, Abuja and Lagos recorded an increase in sale prices between 10 and 12% across the prime neighborhoods in these cities. However, the fall of the naira relative to the dollar has also made purchase of houses much more affordable for those in the diaspora, leading to an increase in demand with its upward effect on the price of the residential units for the local masses. And now shifting focus to the international front, stocks rose to their highest in more than a month today, underpinned by a broad recovery on Wall Street, while the euro was also stuck near a one-week low against the dollar amid talks of more sanctions against Moscow. MSCI's broadest index of Asia-Pacific shares outside Japan built on early gains and advanced 0.3% to hit 602.2 basis points, which is the strongest since February 24. Now, the benchmark has lost 4% so far this year, dragged by big declines in Chinese shares, while the Russia-Ukraine crisis has also hurt their near-term outlook. The United States and Europe are also planning new sanctions to punish Moscow over civilian killings in Ukraine, and President Zelensky has warned so far that more deaths are recorded and likely to be uncovered in areas seized from Russian invaders. European stocks were also headed lower as Euro Stock 50 futures eased 0.1% and London's FTSE futures dipped 0.2%. S&P 500 futures shed 0.08% and Nasdaq Composite futures also slipped 0.05% after Wall Street rose on Monday, supported by tech shares. Global stocks have had a volatile quarter as the Russia-Ukraine crisis and worries over higher commodity prices fuel inflation concerns and cloud the direction of interest rates. In a related development now, looking at the Russia-Ukraine crisis, the World Bank cut its growth forecast for East Asia and the Pacific for this year to reflect the economic impact of Russia's invasion of Ukraine, warning that the region could lose further momentum if conditions worsen. The Washington-based lender said in a report today, and it expects that 2022 growth in the developing East Asia and Pacific region, which includes China, to expand 5%, lower than its 5.4% forecast in October. According to the World Bank, growth could also slow to 4% if conditions worsen and government policy responses are weaker. China's economy is expected to grow by 5% this year, down from the previous 5.4%, which was the earlier estimate, noting it is government's capacity to also provide stimulus to offset adverse shocks. The war between Russia and Ukraine, which Muda Yusuf says was the most serious risk to the region's growth outlook, is also leading to food and fuel price increases, financial volatility, and reduced confidence all over the world. And meanwhile, the United States stopped the Russian government on Monday from paying holders of its sovereign debt more than $600 million from reserves held at American banks in a move meant to ratchet up pressure on Moscow and also eat into its holdings of United States dollars. Under sanctions put in place after Russia invaded Ukraine on the 24th of February, foreign currency reserves held by Russian central banks at U.S. financial institutions were frozen. But the Treasury Department had been allowing the Russian government to also use those funds to make coupon payments on dollar-denominated sovereign debt on a case-by-case basis. On Monday, as the largest of the payments came due, including a $552.4 million principal payment on the maturing bond, the United States government decided to cut off Moscow's access to the frozen funds. An estimated $84 million coupon payment was also due on Monday on a 2042 sovereign dollar bond. Now, the move was meant to support Moscow to make the difficult decision of whether it would use dollars that it has access to for payment on its debt or for other purposes, including supporting its war. And wrapping up business news now, oil prices on the international market extended gains today as the United States and Europe plan new sanctions to punish Moscow over the alleged war crimes by Russian troops in Ukraine, adding to concerns about supply disruptions while Iran nuclear talks stalled. Now, US West Texas Intermediate crude recorded a price surge of 1.75% to hit $105.10 per barrel. Brent crude now sells at about $109.30 per barrel, registering an upward price margin of 1.69%. Bonnet Light's performance is now back in the green territory with an uptick of 1.55%, selling at $108.70 per barrel, and for the OPEC basket, crude oil dealers offer $104.90 per barrel, recording a price dip of 2.64%.